I'm going to talk a little bit about the exploration, but mainly kind of the people, because while I believe you have to have a model, you have to know what you're looking for, you have to have people that really know what they're looking for. And I'm really proud to be associated with a group of folks that I've worked with for the last 20 years, 15 to 20 years, and they've been associated with companies and teams that have delivered over 100 million ounces to the portfolios of Placer, Barrick, Agnico Eagle, and Santa Fe Pacific. And what I really like about that 100 million ounces is that most of those mines are still in production. So they know what they're looking for. We're looking for gold that makes money. So with that, I'll start with this little movie here. So that's the main transportation artery through northern Nevada, connects Chicago to San Francisco. The railroad is there, so you got a rail line. You've got power lines running through the project. We'll see a number of high voltage, 240 kV, as well as 120 kV power lines running in and around all of the bright patch operations. Okay, so here we are on the top of Lincoln Hill. We're really standing on top of the Lincoln Hill ore body here. The resource is roughly 600,000 ounces of measured and indicated, and about 400,000 ounces of inferred. We're looking at a project timeline that could put this deposit into production towards the end of 2018. We're looking at a project that has very robust economics with at current gold and silver prices, roughly a $50 million net present value and a 60% internal rate of return. So it's a very robust project, mainly because you've got good metallurgy in both gold and silver, very low strip ratio. As I said, we're actually standing on the ore right here. And as you can see over my shoulder is the Rochester mine. So we're very close to the Rochester mine. It's roughly 2 kilometers away. That's the open pit you can see over the top of me. And then just another 2 kilometers past that is Barrick Gold's Spring Valley deposit, which is just back over the hill in that direction. So we're in and amongst a lot of mining operators, and you know, the project we have looks very good. We've done our initial economics at $775 gold. Over the next few weeks, we'll be starting our metallurgical program, which will look at kind of a size, crush size versus gold liberation. So our current PEA has just a run of mine that's drill blasted haul to the leach pad and the waste pad. What we're looking at is perhaps an incremental amount of capital increase, maybe somewhere in the order of $3 to $5 million, in which if we crush, we might be able to achieve similar recoveries as they see at the Rochester mine, which is 92% for gold. And if we can do that, you can see that might have a good effect on the project in that we'll mine the same number of tons but get 40% more ounces. And so it's a very robust project, makes a lot of money quickly, and is, you know, probably one of the next mines that will be permitted in Nevada. Okay, as you can see, we're focused in Nevada, and we have a really nice project that has a very nice, robust economics, even at these gold and silver prices, and that's what we're driving forward. There's our forward-looking statement. I will make forward-looking statements, and I'll probably make some backward-looking statements as well, but fortunately, hopefully they'll be funny. I just want to start with this picture, because I think this is how a lot of investors feel today. This is, you know, it's a tragic market, and we just feel like we've just been blown up, and we haven't been able to do anything. And I guess what I'd like to say about that is, you know, what we really need going forward is we can't continue to have models and financial models where we're going to look into the future and say, well, you know, when gold gets to $2,000, this is really going to be a great project.
What we have to do is say, look, this is what the gold and silver price is today. And if it's going to go up in the future, then that's going to be a good thing for us. But we need to be able to work in the confines of whatever the market is today. And we need, some innovative thinking, right? We need to combine different sorts of objects together that create value for shareholders and create value for the company and allow it to move forward into what I think is the new reality. And that is, this is the market, and we better get with it and find things that work. So in that light, there's some old thinking, and you guys have seen it. I went to a presentation not so long ago where the guy was going to spend $600 million to make $200 million. Had a great deposit, sounded like it, but it sounded like he was going to spend a lot of money to make a little money. And that's just not where we need to be. That's not going to help investors, and that's not going to help the industry move forward. We've seen it, where, what financial criteria? Oh, we can work anywhere. Well, we can't work anywhere. We've seen it. People had stuff in Burkina Faso. What happened? It didn't work out very well, right? And so we've seen that the world is not getting bigger like it was in the 90s. It's actually shrinking. And you want to be in those jurisdictions where it takes some time to move forward with a mine. It doesn't happen overnight. I always tell people the worst thing that happened to mining was the internet, because people think that they can go and Google and it comes up right away. But that's not how mining works. It takes a lot of shoe leather and sampling and drilling, and those things don't happen very quickly. So we need a new way of thinking, and where we're headed is to look at these ideas of having a sub-$1,000 gold project, being able to look at the capex. We can't build these billion-dollar mines. I remember about maybe 10 years ago, someone told me, man, if your mine doesn't cost $1 billion, it's not a real mine. And now look what's happened. A lot of those projects have blown up. Look at Pascua-Lama. It's really in a bad situation. So we really need to look at things that we can actually do at a sub-$1,000 gold, have a capex that we can afford, what I like to see is this NPV to capex ratio where, if you put in $1, you get $2 back, because that's better for a mine, it's going to last, and it's better for investors. And I think, Peter said this once before, that the best determination of if you wanted to boil everything down to a single number, is to use internal rate of return. And Peter, you correct me if I'm wrong, but I think I've heard you say that in the past. And again, you want to be in a safe jurisdiction. So, our thing is you can't wait and say, well, look, when gold price is 2,000, this is going to be great. You know what? Because if it works at 1,000, it's going to be fantastic at 2,000. And that's the kind of things we should be looking for. So, as most of you have probably already figured out, we're Nevada focused. This is what a lot of people think about Nevada. When I tell people I live in Nevada, the first thing that comes to their mind is Las Vegas, or dancing and diddling, as we like to say. But really what Nevada is all about is it's one of the premier gold provinces of the world. If Nevada were its own country, it would be 4th or 5th ranked in the world for production. And so because of that, you've got all the major mining companies operating in the state. And that's what Ripatch has done. It's positioned itself in and amongst those operators, and we're finding good things that those guys have passed over. And we're working in some of the best regions in the state. We've got 2 areas that we're working on the west side, we call the Oriana Trend, and in the east central part of the state, along the Cortez Trend. And we'll take a look at each one of those. So on the Oriana Trend, we're nestled in amongst Barrick here in green, the Rochester mine here in orange, and here we are out here in blue. And this is our Lincoln Hill project. Just give you a little, this is Rochester. It's a heap leach only silver mine. Produces between 4.5 and 5 million ounces of silver annually. It comes from a heap leach with a Merrill-Crowe system, so a real high component of silver. This is Barrick's advanced project called Spring Valley. It's a joint venture between Barrick and now the defunct Midway Gold. But it's about a 3 million ounce gold property. And our Lincoln Hill project is roughly 600,000 ounces of measured and indicated and 400,000 ounces of inferred. And this distance between us and the Rochester mine is roughly 2 kilometers. And if you saw in that movie, you saw the mine workings over the top. That's this mine here. This box, we'll talk a little more about it, but that's where our cash flowing royalty comes from. So when we stand up on the top of Lincoln Hill, The nice thing about it, we can see the trucks going, and every one of those trucks has 3.4% ore in it that's ours. The sale of that ore is ours. So in 2014, we did a preliminary economic assessment on the Lincoln Hill project. And what we wanted to do was come up with something that we could actually mine and pay back the CapEx. Okay, so we've seen some of the issues that have happened, say with Allied Nevada or with Midway Gold. They haven't been able to pay back the CapEx, and they actually went bankrupt. They had too much debt out there. And so to do that, what we decided to do was look at $775 gold and $13.50 silver. And that's the Whittle pit that we designed and put on that resource. And then internal to that, we started to look at a number of different gold prices. So if we use today's gold price, well, let's use yesterday's gold price. It's about it's about a 50, little less than $50 million NPV and about a 50% internal rate of return. So this thing, as long as gold's above $775, this thing will pay back the capital. And what you see a lot of times is people want to go out and make a big pit because it looks better to investors. Look at all this gold and silver we have. But really the way mining works is you've got to have a starter pit. Once you get to the starter pit, the rest of that resource, if you pay back all the capital, is gravy. So let's look at some of the value drivers of Lincoln Hill. First part of it is this thing sticks out of the ground. You can actually stand on it. One of the reasons we went to this part of Nevada is because it's really been overlooked by a lot of the major and mid-tier companies. They have all gone east and looked for Carlin-type deposits, which is a good thing to do, but very hard to find, and a very competitive area. We went here, we've been able to stake 140 square kilometers, and we have the Lincoln Hill resource and some other resources we won't even talk about today. But it's a very underexplored area, and the more we drill, the more we find. So just looking at the strip ratio, it's a low strip ratio. It's less than 1 to 1. So it's about 0.5 to 1 strip ratio, waste tons to ore. The high grade is on the top. It's got a very nice grade profile. So you don't have to go out and wait to get the high grade. The high grade comes first. Those are the first ore blocks onto the pad. And one of the interesting aspects about the district is the fact that both gold and silver have very good metallurgy. As I said earlier, our neighbors, the Rochester Silver Mine, they produce almost 5 million ounces of silver per year from a heap leach operation. So we know silver leaches good, and our data indicates that it leaches good at Lincoln Hill. And then Nevada is well known for infrastructure. I always tell people, you see a drill hole from a company, 10 grams of gold, 10 grams oxide gold in Mongolia. And I guarantee you that a half-gram gold in Nevada will make more money than 10 grams of gold in Mongolia, simply because you've got infrastructure. Here at Lincoln Hill, we've got people, power, water. We've got a substation sitting right on the project. And of course, we like Nevada because it's mining friendly. So let's just look at some of the aspects of the deposit. This is our PEA pit, preliminary economic assessment, done at $775 gold and $13.50 silver. This is what the pit would look like if we used $13.50 gold. So, that's a good thing, because I think everybody in this room will believe that at some point, gold and silver are going to rise. But you know what? Today, we've got to worry about how we're going to pay back our capital, and so that's what this starter pit does. It ensures that we can get to a time when gold's $13.50, because if we go bankrupt before, who cares, right? Initially, we did 12 composites for our metallurgy, and we saw very good recoveries for both gold and silver. You can see here. We've also did 3 composites for sulfide, and one of the things we notice is the composites for both gold. The composites for gold and silver, or gold in the sulfide and gold in the oxide, are relatively the same. What really changes is the recovery rates in the sulfide for silver. And that's really because this thing sticks out of the ground. It's got a supergene component to it. So when we start to see sulfides, we really see a drop-off in the grade. Again, we talk about the ore blocks. These are the highest grade blocks. It's basically 40 grams of gold equivalent. Those are the first blocks to the pad. And in our initial kind of setting, what we think of is kind of a real simple heap leach, run-of-mine type operation. So, all we're going to do is drill, blast, and haul. If that material is below the cutoff, it goes to a waste pad. If it's above the cutoff, it goes to the leach pad. So, you know, there's no fancy anything here. This is real tried and true mining technology. In fact, it's one of the reasons why Nevada is one of the biggest gold producers in the world. And so, with relation to that, you know, we're using 64% recovery for gold and 59% recovery for silver as a run-of-mine operation. Okay, let's just look at some profiles then with respect to the strip ratio. You can see the strip ratio always stays below 1. The average is about 0.5. In year 2, it's, you know, about 0.25. So pretty low strip ratio. Here's a grade profile. The highest gold and silver grades are at the beginning, and they tail off to the average grade of the deposit. So you're going to make all your money back in the first year. So that's a good thing because you're going to make payback in year 1. Okay, so what we've been doing lately is we've been working on a second phase of metallurgy. And like I told you before, and I'll probably repeat it many times going forward, and that is about the Rochester mine. So that's kind of our model, right? They have a silver gold mine, and they crush. And when they crush, it's basically, well, let me backtrack. It's basically the same geology as Lincoln Hill. But they crush their rock. And when they crush, they get 92% recovery in gold and about 62% recovery in silver. So as I told you, we're just using run-of-mine. So we went out and did another set of drill holes to go back and do a phase 2 metallurgical program. Collected about 12 tons of material in a core drilling program. And we've got column testing going right now. And one of the aspects of that column testing that's going to be really important for us is we're going to look at some different crush sizes. Now, obviously, we want to build this curve of gold liberation versus crush size. So we know that at the Rochester mine, they get 92%. So if we can approach levels of that for recovery in gold, we'll mine the same number of tons, but get more metal. And if we can get more metal, that's going to impact the NPV. So this is our program that's going on right now. Those results should come out in Q1 of next year. And so this is just an illustrative cartoon of what we're doing. So in our PEA, we looked at run-of-mine. So that's just drill, blast, haul, send to the leach pad. Put some cyanide on it and get the gold out of it. And in that model, we're using these recoveries. Our neighbor is the same, only they have a crushing circuit. So what we're talking about here is adding maybe $3 or $5 million for a crushing circuit into our CapEx, which is already pretty low. Our CapEx is 30, maybe it'll go to $35 million. And we might be able to achieve these types of recoveries. Okay, so let's just look at the timeline we're on. Our goal is to be into production by the end of 2018. And right now, when I was here in April, we talked about our metallurgical program and our infill drilling program, and those are on track to be done here in the first quarter of 2016. The design, engineering design and process, pretty standard. I think you could probably go to Costco and pick up a box that says 5,000 ton per day heap leach plant, and it's pretty much designed for you. So again, it's not a big aspect of, you know, we're not creating anything new here. We're using tried and true technology, right? So it's a bunch of pipes and a pile of dirt and some water goes on it. We'll have a new resource and PEA come out in the third quarter of 2016. There we'll have some more refined cost. We'll know about this crushing, and we'll have a new resource because that infill drilling is probably going to add to our resource. And then we're still on track to have a feasibility done by the end of 2017. Our biggest bottleneck is permitting. So to minimize the time of permitting, we're doing our permitting now. We believe that this is going to be a mine, so we're running our permitting concurrently with our feasibility study. And the idea is we'll come out here at the end of 2018, be able to start constructing a pad and go into production. Now, the way I sort of look at it is we have a royalty income stream. And so that's basically free money to us to do all this. We have all the money we need to get through feasibility, and we'll actually have money left over to buy some of the capital purchase. What we'll have to do is come back to the market, say to a bank, and get a loan. And that's how we'll finance the rest of the capital. But really, you can see here's our royalty, and what we're doing is taking those low-risk dollars, and we're going to leverage them up into more low-risk dollars. And one of the things I have to say about finding new deposits is if you're not in the game, you're not going to find new deposits. So This keeps us in the game. The royalty keeps us in the game now, and the cash flow and revenue from the mine will keep us in the game in the future. Okay, let's just look at some upside around the Lincoln Hill property. So again, here's Lincoln Hill, here's our 1 million ounces. We have two targets. To the south is Independence Hill, which is basically just the strike extension of our known mineralization. Off here, 2 kilometers to the west, is Gold Ridge. We're currently drilling there now. We've been able to bring some drilling forward because of some extra acreage we had from permitting. And so what we sort of envision is, here's 1 million ounces here. Perhaps we'll find another 500,000 ounces here. Perhaps we'll find another 500,000 ounces here. Now you've got a district with 2 million ounces. You can bring it to a central leach pad. As I said, if you draw a circle maybe 2 kilometers around, it looks like that. Okay? And you can see kind of the synergies that there are between our stuff and Barrick, our stuff and core mining. Okay, development work for a geologist is really boring. In fact, it's tough to go to the same place as an explorationist day after day after day. So in my life, I have to have a little bit of excitement. Sorry, George. So excitement for me is going out to a place where you don't know what you're going to find, and maybe you're going to find something big. And so that's why we like the Cortez area. This is Barrick here. This is McEwen mining here. So we're sandwiched between Barrick and McEwen. And what's really interesting about our two projects, Garden Gate Pass and Paddy, is they're right next to a new major discovery, and that's Gold Rush. Our Garden Gate Pass property is about 3 kilometers south of Gold Rush, and it makes a nice little trend onto our property. The problem with our property is it's covered. We don't have any outcrop of any kind, so we have to go and use lots of geophysics, and we actually have to use drilling to find out what's actually under the ground, because there are no outcrops and to produce our model. But what's nice about that is we kind of plod along, and we get to see mining. Every day we drive by one of the largest mines in Nevada to get there. And that's the one reason that we really like this part of the world. Since 1991, there's been over 50 million ounces of gold discovered, mined, and processed. That's a pretty short timeline between 1991 and now. And the more they drill, the more they find. And so the reason I really like the Cortez area is because I think it's going to be the next Carlin Trend. And I think if you have land on it and you can figure it out, you're probably going to find a deposit. And we all know, as we just saw, that discoveries transcend the market. Right? We saw that with Mag Silver. So here going forward into 2016, as I mentioned, the metallurgical program, our infill drilling, new resource estimate and PEA. We'll do some exploration drilling on those two targets in Q2 and Q3, and then we'll come back here to Cortez. And we have a measured program there, right? We tend not to do lots of drill holes. Each drill hole costs about $200,000. So 5 drill holes is $1 million program. So we tend not to go wild out there, if you will. Okay, why is that all good, and why am I here? Well, I'm here because one of the things that I really like about Rye Patch is I don't have to keep coming here and asking you guys for money every 6 months. We're a self-funded company. We've got a royalty that puts out $1 million per quarter, and this is what we received to date. It's got 15 quarters remaining, so about 3.5 years. That's going to be plenty of time for us to leverage those dollars into more dollars. The other thing I like about it is if we just use $1,000 or $1 million a quarter, that's $15 million. If silver price goes to $25, it's $30 million. So if silver price goes to $25, we'll have all the money we need. We won't even have to go to the bank to finance the mine. We'll have the money in the bank. And so what it really represents is progress without dilution. Just a little bit about my team and I. As I mentioned, I think people are really important. The exploration team I work with is second to none, in my opinion. And just a little bit about me. I came out of a small company. You guys might remember. I actually worked with George. We came out of Placer Dome. And I ran the U.S. and Latin American exploration for Placer Dome. And then we just recently started to add to our management team. We used to have CFOs for hire. Now we have our own internal CFO. when you're a cash flowing or revenue generating entity, you tend to have issues with tax and things of that nature. So you need somebody in-house who can help you navigate through those kinds of difficulties. Our board, Jonathan Chalice, well known in the junior space, mainly with his work with CM Oliver and on the board of a number of junior companies. Charles Russell, on the board of Ivanhoe Capital, mining engineer, lots of experience in Africa. He keeps us on the straight and narrow. And then Randy Buffington, very well versed in heap leach in Nevada. In fact, is probably one of the smartest guys in heap leach technology around. This is our share price, not quite as spectacular as Matt's, but I think that's the opportunity. We have all the pieces in place. We're moving forward. So there's our share count. But we've got some pretty good investors with Sun Valley, US Global. Ken Ross Gold holds about 10% of the company in Europac, and insiders have 5%. That's me. One thing I'll just mention before I go is we have a share buyback program. We've looked at a lot of opportunities throughout the western U.S. I caution investors to read the technical reports closely because things are not always as they seem. And because of that, we've decided to invest in ourselves, and that's why we're buying back some of our shares. So I thank you for your time and your attention and the opportunity to present today. Thank you very much.